This video will provide a walkthrough to the solution for exercise 1217, which focuses on accounting for settlement of troubled debt. Here's the data for our problem. As at December 31st, 2025, Smith & Smith Company owes $25,000 to First Nearly Trust Company for a 3-year 8% note due on this date. The note was issued at par. Unfortunately, the oil and gas market has dropped significantly, so Smith & Smith is in serious financial trouble due to the decrease in sales. First Nearly Trust agrees to some concessions as follows. Extension of the due date from December 31st, 2025 to December 31st, 2028, a reduction of the principal amount owing to $18,000, and a reduction in the interest rate to 6% payable annually on December 31st at a time when the market rate was 7%. A requirement is to prepare the journal entries for the debtor, i.e. Smith & Smith, for December 31st, 2025, 26, 27, and 28. So the first step involved in accounting for troubled debt is to determine if the renegotiated debt is a settlement or modification. So we know that the present value of the old debt is $25,000. That's the amount due today. With the renegotiated debt, the new interest payment would be 6% of $18,000 or $1,080 per year. We must then calculate the present value of the new debt based on the interest rate that was applied to the old debt. So using our financial calculator, we'll take 3N, 8 IY, 1080 PMT, and 18,000 FV, and compute the PV to be 17,072. Next, we must determine something called the concession amount, which is simply the difference between the present value of the old debt and the new debt. So if the old debt was $25,000 and the new debt present value is $17,072, the concession amount is $7,928. What we have to do then is determine the proportion of the concession amount to the old debt present value. So we'll take the $7,928 and divide by the $25,000 present value of the old debt to end up with 31.7%. What we do is we compare that 31.7% against a threshold of 10% required to determine if the negotiation is a settlement. In this case, the concession amount of 31.7% is higher than the 10% threshold. Therefore, the renegotiation is classified as a settlement. As a result, the old debt must be removed from the books, and the new debt is recorded with the new terms at the current market interest rate. So we'll calculate the PV of the new debt with the current rate using our calculator, 3N, 7 IY, 1080 PMT, 18,000 FV, and compute PV to end up with $17,528. Now we can record the journal entries. So starting with the journal entry at December 31st, 2025, because this is a settlement, we must remove the old debt. The current carrying value of the debt at its present value is $25,000, so we'll debit the note payable for $25,000. We'll credit a new note payable for the present value we just calculated of $17,528. And the difference between the two to make our journal entry balance is going to be a credit of $7,472, which is classified as a gain on the restructure of the debt. So we'll credit an account called gain on restructuring of debt for $7,472. The next journal entry will come 1 year later at December 31st, 2026, where we will record the interest on the note. So we can debit interest expense for $1,227, calculated as the initial note payable balance of $17,528 times the 7% market rate, that's $1,227. We'll credit cash for $1,080, which we already know uncalculated, and the difference between the two is the amortization of the principal of $147, which will be a credit to note payable to make the journal entry balance. We could also shortcut the determination of the interest and principal amortization by using the amortization function of the calculator. So press the second function button and then PV, above which you see the word amort. When you see P1, type 1 and press enter. Press the down arrow. When you see P2, type 1 and press enter, because we want to see what the results are relating to the first payment. Scroll down, you'll see the new balance on the note. Scroll down again, you'll see PRN equals 147. And scroll down again, INT is 1,227. So you can save yourself a lot of time using the amortization feature of your calculator instead of calculating the interest manually, but it's always good to confirm that you understand how it's calculated. Then we'll jump forward 1 more year to December 31st, 2027 for the next interest payment. This time I'll start with the amortization function in the calculator to show how we can shortcut this. If you're already in the amortization mode, simply scroll back to where you see P1. Now type 2 and press enter. Press the down arrow for P2, type 2 and press enter. So we want P1 and P2 to equal 2, and this focuses only on the details regarding the second payment. Press the down arrow until you see PRN, and you'll see it's $157. Press the down arrow again, and the interest INT is $1,237. The confirmation calculation for this is the initial $17,528 present value plus the $147 principal amortization in payment 1. That sum multiplied by 7% is $1,237. So we'll debit interest expense for $1,237. We'll credit the note payable for $157 and credit cash for $1,080. Next, we'll jump ahead one more year to December 31st, 2028. Our first entry is going to be the same to record the interest. Using the amortization feature in the calculator, let's set P1 and P2 both equal to 3. So scroll till you see P1, type 3, enter, press the down arrow. For P2, type 3, enter. Scroll down till you see PRN, which is $168. Scroll down once more, and you'll see INT is $1,248. We can confirm the interest calculation as $17,528 initial present value, plus the $147 principal amortization in payment 1, plus the $157 amortization from payment 2. That sum multiplied by 7% is $1,248. You see how this is getting to be a lot of work manually, and you're probably really appreciating the amortization feature in your calculator right now. So we'll debit interest expense for $1,248, credit the note payable for $168, and cash is credited for $1,080 for the payment. If you're still in the amortization function and you scroll up until you see BAL, the balance, you'll see that the balance on the note should be $18,000, which means now our final entry is to settle the note or basically pay it off. So we'll debit the note payable for $18,000 because that's what the current balance is, and credit cash for $18,000, and that's the final principal payment. And that's it. We're done with this question.